All right, boys and girls, little lesson on a put calendar spread. That's the topic for this Jedi option segment. A put calendar. Matt teed it up quite well, but let me just recap a couple of the key dynamics in the market that I think make this strategy interesting right now. Listen, sometimes you get an evergreen topic on these Jedi option segments. Today, I think you're going to get something that's very timely and relevant to what's going on in the marketplace today. So, before I get into the structure of the put calendar, understand what type of market we're dealing with. This is going to give you a glimpse into strategy selection. Right? What's the ideal strategy? When I try to pick an options trade, it's really two parts, right? It's really three. So part one in strategy selection, right? Part one is what's my directional bias? What do I think the market's going to do here? That comes into play. And I'll tell you here's what I think the market's going to do. We are overextended, okay, but really bullish. That's really what it takes to get you overbought like this. We're not overbought, guys, because we're still in a massive downtrend. And that's not the case. We're not overbought because we just had a weak rally. We are overbought because bulls have stampeded into the market for 2 months straight and just killed bears left and right. It's a slaughter, okay? What has happened the last 2 months is not bearish. It is very much bullish. But we're extended. And so the risk reward is not great for new bull trades right here. We've been talking about that the last 30 minutes. What I think is altogether most likely in the marketplace right now is either A, we pull back, and that pullback will get bought. That's my bias. I think the dip gets bought. Not a matter of if, just a matter of when. Is it a shallow retracement, a deep retracement, et cetera? But I think we pull back and it gets bought. So I don't want to do something aggressively bearish. That's off the table. Buying long puts, which is redundant. Going long puts or buying puts. That's too aggressive for me, right? Doing a bear put spread, a little bit too aggressive for me, right? If we pull back, I think it's not aggressive. Or maybe we just chop sideways. Okay. Or listen, maybe we keep going up and today's a fake out, but at some point we do actually have a pullback. Okay. Look at all three of those lines: down, then back up, choppy sideways, up, but then pullback. In all three cases, I essentially think the market could be around the same price level a week or two from now. So I want to build a trade that makes money if the market pulls back a little, pauses, maybe goes up a little further, and then pulls back. In short, I want to be delta negative. Not aggressively so, but I want to be delta negative. Okay, so I expect prices to pause or pull back and bounce, or maybe go a little further and then retrace. Okay, that's my bias. So would I do a aggressively bull trade in that scenario? Well, no, that's not my bias, right? Again, I think something that's slightly delta negative, right? So slightly delta negative, I think makes some sense here. The second thing I'll consider is my existing portfolio. What do I already have on? Listen, if I'm super bullish, forget super. If my existing positions are just bullish, period, I'm not worried about what happens if the market keeps going up. I've got that on lock. Like, I'm already going to make money. I'm more worried about what if this glorious 2-month run ends and we pause or pull back here. My existing portfolio being bullish, it's harder for me to add more bull trades here because I'm increasing the risk that I already have. It's a little easier for me to add bears here because I'm decreasing risk. Okay. And so easier to add negative delta to hedge existing positions, right? And reduce the risk in the portfolio, which might be prudent given that we just ran a 1,000,000% higher over the last 2 months. The third thing that would come into play for me trying to decide what strategy to do here would be implied volatility. And when you look, basically our options cheap or expensive, okay? When you look at the VIX, which is one way of looking at implied volatility for the S&P here, we're low, like really low, almost the lowest we've been all year long. Option premiums are cheaper than they've been in a long time. Justly so. The market's quieted down. It's slowed down. We're not seeing 2% daily moves. Okay. It's very, very quiet out there. So option premiums have gotten cheap. Okay. It's certainly cheaper than they've been most of the year. So it's low right now. So I'd rather be a buyer of options. Okay. So in other words, the easiest trade for me to add to the portfolio is something that is negative delta, positive vega, where I'm long volatility. I benefited from volatility rises. And also, because I always like to have this, positive theta. Okay. I want to add theta to the portfolio. I want to sell options in some capacity where I have a positive theta trade. I would love to add something to the portfolio that has those characteristics. I think that would be a good match given my directional bias, given the existing portfolio, given my bias on volatility. Okay. Now, I could be wrong, but I put together, I think, a fairly compelling reason for whatever strategy matches this negative delta, positive vega, positive theta. And if you go through your tackle trading playbook, it's on our website, that has delta strategies, vega strategies, theta strategies, and you filter through those and you say which one checks all these boxes. There may be multiple, okay, but my favorite one is a put calendar spread, specifically an out of the money put calendar. Okay, and it's not a diagonal spread; it's going to be a horizontal spread. So if you want to be really redundant here or specific, an out of the money put horizontal calendar spread. Okay, that's the strategy. It's slightly negative delta. It's not an aggressive bear trade, slightly bearish trade. It's long volatility. Okay, it makes money as time passes. I did a video yesterday or the day before, I can't remember, for the Tales of a Technician blog, okay, on put calendar spreads. Spent about 20 minutes, 25 minutes building one of these and walking through. You're getting a pared down version for this Jedi option segment. I'm going to pitch this in Trade Masters tonight. I've got to redeem Matt and off Greg, right? He's dead. Like we got to get revenge. How dare he beat the CEO of tackle trading? We're going to get it. So I got to bring the heat, and I think for the wild card round tonight, a put counter spread makes some sense. So basically, the way you structure this, is I like to use an index or an ETF because they're super liquid and it's the most direct way to bet on my bias. Okay. In other words, if I think the S&P is going to pause, pull back, do everything I just said, I think it's going to do, and then I go put a put calendar on Google. Well, maybe Google doesn't do what the S&P does. Maybe the S&P does exactly what I thought it was going to do, but Google does something completely different. And even though I was right on my read, I placed the bet on Google. I don't want randomness to fuss with this trade. I want to place it directly on the market, which is using an ETF like the S&P or IWM or the NASDAQ or the Dow or whatever. Okay. For this illustration, I'm just going to use the S&P. Tonight, I might use a different one. Okay, you have to come and see for Trade Masters. But basically, I'm going to set up this calendar spread slightly below the current price of the market. So we're around 426. So I might put it right around like 420. And it's going to create a profit zone that peaks at 420. Which means I want it to go from 426 down towards 420. Now, it's going to be a bigger profit zone in that area, but that's going to be where it peaks, the sweet spot. Okay. And then if the market pauses, that's okay. I'd prefer it pull back to 420. Okay, but if it pauses, that's fine. If it keeps going up, I'm going to be a little bit in trouble. And there are ways to handle that. I usually add another put calendar at a higher strike price. It widens the profit zone. Okay. But let's build this out. So the structure of a put horizontal spread is you buy a longer term put and you sell a shorter term put against it. In this case, I'm going to buy in October, probably 420 put, and I'm going to sell a September 420 put against it. So the reason it's a horizontal spread is you're buying and selling the same strike, but different months. Okay, so it's horizontal. Well, slightly out of the money. Again, you should set it up. The strike price is the target. So depending on how bearish you really are here, you could shift this lower or higher, depending on if you want to be a little more neutral, a little more bearish. The interesting thing about horizontal spreads is they can be bullish, they can be neutral, they can be bearish. You just got to pick the strike. You want to set this up neutral, build a 426 put calendar. That's right at the money. You want to be a little bearish, go a little below the market. You want to be a little bullish, go above the market. Well, again, my bias from previous, well, maybe I am kind of neutral, actually. Certainly not bullish, or at least I'm not bullish. I got bullish taken care of. My existing portfolio takes care of the bullishness. I'm more concerned about if we pause or pull back, right? So that's why I want to add the bearish variation of this put horizontal. So to build it out, I'm going to go to the monitor tab or the trade tab, and I'm going to buy a 2-month option and sell a 1-month option against it. So we're going to come to October, and I'm going to look at the out of the money puts. Okay, 420, about a 41 delta. Let me actually go to September 1st. I want to make a point on this. 420 is around a 38 delta. It's probably not as bearish as I usually go. Usually I go around like a 35 delta or a 30 delta even. Somewhere between 30 and 40 delta is usually around the distance out of the money I go on these. 420 I think is fine. It lines up with Matt's target of maybe 4,200 being like the ideal key support level that we don't want to break. So maybe that's a target on the downside. So I'm going to sell the 420 put, and I'm going to buy. I'm going to go to October, and I'm going to buy. I just control click to do that. Control click to buy the 420. Okay, so it's a calendar spread here. It's puts at the 420 strikes, and it cost me $4.82. If we right click and analyze, clean this up a little bit here. This is what the trade looks like. Now notice the Greeks. Notice the Greeks. What's the delta? Delta is negative. It's slightly bearish. Theta, positive. I'm making money as time passes. Vega, positive. I make money if the VIX goes up, if implied volatility pops, which it usually does when the market pulls back. So I've checked the boxes. I got my negative delta. That's going to reduce the risk of my existing portfolio, which is bullish. Picked up some time decay. Got long vol. Listen, most of my trades are short volatility. I'm selling puts. I'm selling calls. I'm selling condors. Most of those are negative Vega. So to get a positive Vega trade in the mix reduces the overall vol exposure. Well, look at the chart. You got a pretty wide profit range between 435 and about 405. So let's just look at that on the chart. So 435 on the upside, upper break even, lower break even 405. Even though 420 is the target, 405 is kind of the lower break even. I like that range. I think there's a decent chance the market could be in this range a couple of weeks from now, particularly if I'm slightly bearish here, if we pull back or pause, right? And if it goes above 435, I'll adjust this trade or just take the loss and make money on my other bull trades, right? So I like the profit range. I think it matches my bias. That's part of the benefit of using a risk graph. Make sure the profit range matches what you think is going to transpire on the chart. Now, what do I do if I'm right? For me, I usually am looking for about a 15% return. So if I bought this for $4.82, I'd be shooting to make, well, 10% is about 48 bucks. 15% would be $24 more than that, which is 70 something, 74, 72. So basically, I would like the stock to pause. I would like time to pass. Okay, you get enough time passing, get a little bit of a pause or pullback in the stock, bada bing, bada boom, you've made your money. Okay. If the market crashes, we're going to be a little bit in trouble, but usually you got plenty of time to exit this thing around break even or a small loss if we go down too far. Okay. The bigger concern is if the market goes up too much. So let me throw this one other idea at you, then I'm going to wrap up. If the market goes up too much, that's a challenge because it's going outside of my profit range. I kind of call this my tent. This is my profit tent. Stay in the tent. It went out of the tent. It went up too much. I got to expand the tent. I got to put in another put calendar to widen the profit range. Okay. So basically, I think we get up to 440 and it's gone up too far. Right. This thing runs up to 240. I mean, it's gone up too much. But listen, if I think it's going to pull back now and it goes up another 10 points, it's even more overbought. I think it's even more likely to pull back at that point by virtue of how much more extended it got. And so rather than abandon the trade, I'd actually like to just shift the risk graph higher so that maybe this upper break even goes up so that I widen the profit range on that side. And you can do that just by adding another put calendar. The first one's at 420. What if I just added another one at 430? Look what that does to the risk graph here. Instead of having one peak at 420, you have a second peak at 430, and it widens the tent. What was too far away, stock price up at 440 or so, being well outside the tent, you had a second put calendar up there, you widen the tent, now 440 is in the profit range. Okay, so the idea here is if you're right on the first one, good, great, take the profit, move on. If you're wrong because the market went up too much, you can maybe layer in a second one, widen the range, give yourself a little more room, and then if the market pauses or pulls back, if you were a little early, in other words, in your call, there's a way to fix it. Now, in fairness, if this thing just runs up to 460, forget it. Like, you're going to lose on this sucker. Okay. But the premise is you got other bull trades in the existing portfolio. So I'm not sure that's all that bad anyways. Right. But bottom line, I love the idea of a put calendar spread in this situation. And another reason I love it is because I don't have very many strategies, if any, that fit this. Normally in a market environment like this, you're not adding any trades because you say, well, it's too overbought to do a bull trade, too strong to do a bear trade. Got to wait for the next setup. Listen, this is a strategy that in this particular environment, bull market, uptrend, overbought, low IV, your existing portfolio is bullish, falls low. Like, this strategy makes some sense as an added position into a portfolio.